January 10th Finance Committee meeting of the Sacramento Metropolitan Fire District. Let the record show that all directors are present. Director Gay Jones, Director Jack Scheidegger, and Director Gary Monk. We'll call this meeting to order. Public opportunity to discuss matters of public interest within the committee's scope, including items on or not on the agenda. Did we get any requests?
No, we did not.
Okay. Next item is going to be the consent agenda.
I move that we approve the consent agenda.
Yeah, I second.
Okay, we have a motion and a second to approve the agenda.
Roll call. Director Scheidegger,
Aye.
Jones,
Aye.
Monk.
Aye.
Motion carries. Thank you.
Okay, the next in a big category, the financial reports. November 2012, our CFO McFarland. Welcome.
Good evening, Finance Committee. Rhonda McFarland, Chief Financial Officer. Tonight, we're reviewing our interim financial statements for the period ending November 30th. And I will mention that we have both my name on there and Assistant Chief Fire Marshal Chief Ray Iverson. And I'm going to be presenting the revenues, and then after that, he will be coming up and giving you a lot more details on what his division's doing in regards to all the inspections and the projections of revenue for his group. And then once he's complete, then I will continue on into the rest of my report. Okay. This cash balance report references back to the report that you received, page 5. And I will mention that you received a revised page 5, and we were able to make one correction. We had the reserves for the workers' comp were in there twice. You can see the bottom line on the revised page is reduced by the $4 million. That's the workers' comp reserve. And we will make sure that doesn't happen again. But as with other months, you can see that we're trending just a little bit above cash-wise where we were in the previous 2 years. Okay, looking at our reserve funds, this references back to page 6 of your report. And we are trending just a little bit above at this point the reserves in the prior year. The numbers in the table have been revised to reflect our audited numbers, so our audited reserves, and the percentages for beginning and ending came down about 1%. And when I analyzed the differences, because we were at about 9% last time, plus we had brought in some additional monies that had been restricted before, basically, we have more money restricted in the current year than we did in the prior year. So when you hear from our auditor, one of the notes in your financial statements, I believe it's note H, details out what's in our fund balance, and it talks about restricted, committed, and undesignated, I forget. Unassigned. Sorry. They sounds like, we picked those categories, but we didn't. It's in a pronouncement. They have to be exactly what they call for. So that's why these numbers came down a little bit. So that's where we are right now. Okay, talking about medic cost, we're consistent with our previous months that we are at 10.1 million now, up 2 million from the prior year, and it's almost a 25% increase. And we are right where we need to be as far as our budget and the projections that we made for the fiscal year 2013. Community risk reduction, this is the area of our revenue that Chief Iverson is here to address with you. And year to date, we're at $741,000. And that's $174,000 above the prior year, which is a 30.6% increase. But we had budgeted for a much larger increase for the whole year, and the amount collected to date is about 15.4% of the budget. And this refers to page 10 in your report.
Well, it still shows almost $200,000 over last year's year-to-date total, so
Yes.
still in the positive side, yeah.
It's positive, but we're going to have a heck of a last 6 months if we're going to hit the
Yeah.
budget. And that, I know Chief Iverson has looked at it very carefully, and you'll be getting a lot more information when he gets up here, so I'm really not going to go there. But I will emphasize that he went ahead and brought the numbers forward to December 31st. So everything that you're seeing from me is as of November 30th, but when you see his numbers, he's given you a full 6 months instead of 5 months, so.
Yeah, I noted it as well, yeah.
So we're at 41.67% of the year complete for our 5 months. So that's significantly higher than the 15.4%, and that's why I know I've been concerned, and you as the Finance Committee have been concerned. And then our total revenue, and this refers to page 11, is 13.3 million. It's $2.5 million higher than the prior year, a 23.2% increase. So that, to date, our primary source of income has been our medic revenue. So that's what's driving all of that. We have yet to get any current year property tax money. The little amounts that we have received for the 5 months have been attributable to prior years and corrections and such. So at this point, I'm going to go ahead and turn it over to Chief Iverson, and he has, you can see when he goes through his presentation, he spent a lot of work on this for you.
Good evening, members of the Finance Committee, Assistant Chief Iverson, Community Risk Reduction Division. I'm going to overview some of the general functions of our newly formed Community Risk Reduction Division, as you see on the chart slide above. We have 5 major programs in which we administer to Community Risk Reduction Division, as you can see there. Some of the activities that we reported out over the last 6 months are listed here on this slide. The Code Enforcement and Fire Protection Engineering Division, a group of our division, have completed over 4,253 contacts. It's clearly laid out there on the chart. Several of those were annual inspections, construction inspections, permit inspections, plan checks, and exterior hazard mitigation inspections. Our community education folks have completed over 463 contacts, including all their meetings and presentations throughout the community. Our fire investigations division, they have completed 189 contacts through investigations, arrests, warrants. One of the things we're working on to continue to track a little better are our convictions. We are working on establishing data to adequately present that. Hopefully at our next presentation, we'll have more information on those. This slide talks about the revenue or the cost recovery fees, in which, as you can see here, the year-to-date 2012 versus 2011. The dark blue color is the 2011 cost recovery year-to-date last fiscal year, the light blue 2012. As you can see, the inspection fees have risen considerably over 2011, whereas on the flip side of that, the plan review fees have receded considerably down over the previous fiscal year. One of the reasons for that is the market and the economy, the construction. Of all the fees that we generate in Community Risk Reduction Division, we are unable to control the economic construction side of those fees. So we anticipate, as we'll talk further, that that will change in the very near future. One other note on this slide is a new cost recovery fee that wasn't established last fiscal year, our self-inspection fees. They're in the light blue. This slide covers the overall numbers year-to-date, and year-to-date for this purpose of this presentation is July 1 to December 31st, 2012. So you see there the far left column represents those fees that are collected directly by the Community Risk Reduction Division. The second column represents third-party collections, whom we currently use Fire Recovery USA to collect those fees. And the last bar represents the total fees year to date. As you can see, we are considerably over 19%. Excuse me. We are, exact number over happens to be a little bit over 20% over last fiscal year. As alluded to earlier by our Chief Financial Officer, we still have a lot of work to do. We still have a lot of fees left to collect. This slide shows a pie cut of the outstanding, in the dark blue, fees yet to be collected, the cost recovery measures. Our estimated cost recovery total is $4,809,000. So far, year to date, we've collected 19% of that. Just an overview of the programs in which our cost recovery fees will be coming from. First and foremost, our self-inspection program. We have completed, that program has completed approximately 3,360 in self-inspections. With that, we have received 94% compliance with those being completed, and those 94% of those fees have been received. The other note on this slide, we initially estimated 10,000 self-inspection participants in the self-inspection program. Our actual number is 9,574. And we also had assumptions early on that 2/3 of those folks would participate in the self-inspection program. However, we found out the opposite to be the case. 1/3 has participated, thereby 2/3 have opted out for manual inspection. Provided that being the case, we have 6,214 manual inspections that are to be scheduled over the course of this fiscal year. The revenue or the cost recovery from those fees are projected at $1,130,948. With the revenue that's already been billed, the total projected revenue is $1,436,708. And also, it's interesting to note that with that change in our assumptions, it provides for an increase in our projections of $519,000 over our expectations.
Could I ask a question?
Sure.
I know your staff have been doing a wonderful job of dialoguing with our community in terms of the implementation of this program. Has there been any rationale as to why the inversion of the 2/3, 1/3, the manual versus the self-inspection?
Yes.
Why?
A lot of that has to do with, we're dealing with corporations for a lot, part of this chain, franchisees and LLCs, limited liability corporations, who rather professionals do the inspection than having their own folks do those inspections. And we found that a lot of these companies, such as Starbucks and McDonald's and major corporations, already were doing these inspections by hiring private companies to provide that service. So we found that for the most part, most people want us to do it for them. The smaller businesses that may have the resources are the ones that typically would do the self-inspection.
Well, I find that to be a positive commentary on this whole program in terms of you being out there and getting people involved in any form of inspection, which improves the safety to our community And I think the fact that people are so interested that they're willing to have you come out is a positive aspect of your doing this program. So I think it's great.
Moving on to the next program, our annual inspections. We have currently 5,000 scheduled inspections. You saw earlier a lot of inspections that have been completed during the last half of the fiscal year. We still have 5,000 outstanding to complete. Of those 5,000 inspections, we have 1,400 that are mandated, which are required by state law to inspect. We have 3,600 of those that are required due to the nature of their business. They require permits to operate that we have to inspect for a total of 5,000 inspections. Year to date, we've collected $122,609 in fees. We project throughout the remainder of this fiscal year to collect $1,820,000 in fees. The next phase of our fee collection for cost recovery has to do with false alarm fees. This number you see here is based on the 55,000 projected is based on our last 6 months of data. We've made some changes to the way we collect this information and have gone to automation, which eliminates the human component to report these types of false alarms. With our partners with Fire Recovery USA, we have direct means to extrapolate the information from our dispatch notes, and we project that this number will increase. However, year to date, we've collected $1,820, and the current projection is $55,000. Our next fee base for cost recovery has to do with plan review fees. Year to date, we've collected $314,758. This number, the projected number, is actually an actual number from last fiscal year we're using as a benchmark. As you know, our fee schedule recently increased our fees by 30%. So given that, we're using that number as a conservative number. Basis for last year's number is $1.5 million, $1,500,000, absent the fact that our fee structure should substantially increase that to a higher level. So all in all, year to date, with all of our fee structures that we have in place and our fee schedule programs, we've accomplished to be able to collect $916,506. We have projected a collection of $4,811,708. This exceeds our budget of budgeted $4,809,000 by approximately a little over $21. Now, I'm going to talk a little bit about the potential that we have to collect our cost recovery fees. Looking at the top number, which our projection number from the previous slide, $4,811,708. Our budgeted number, $4,809,000. We believe we have a potential of additional $1,308,230. Which gives our total to be $6,119,938. I want to walk you through briefly the reasons why that potential exists. First, based on our current trends, past history, and identified inspection services, these inspections cover future cost recovery fees that are yet to be implemented, such as our weed abatement program, which will be implemented starting second quarter of this fiscal year. We estimate that the weed abatement program will bring an additional revenue of $72,800. We also have not attributed the possibility of future grant awards, which we're applying for. If successful, we will be able to offset the cost of 2 grant-funded positions, which will also bring savings of $150,000. And another assumption to look at the possible potential includes permit inspections. Our conservative number we use to draft the budget is based on 1 permit per occupancy that has permits. Absent having the history of billing and obtaining these fees, we took a conservative approach. Potentially, based on past practice in most applications, we estimate that businesses will have at least 2 permits per business that are required to have for their occupational function and use. So that would increase our potential revenue collection for permittable occupancies to $327,600. Another assumption that we look at is our false alarms. Forecast was done by Fire Recovery USA prior to entering the budgetary process, and they estimated well over 1,000 alarms per year, false alarms, that would meet the qualifications for false alarm mitigation fees. Given that being the case, if we were to reach those potential false alarm numbers at the average of our $362 per invoice false alarm fee, we could see an increase in false alarm fee generation of $307,830. And lastly, as I mentioned earlier, the fees have been increased, our fee ordinance was increased by 30% over last year. Our actual budgetary revenue for plan review, plan checking fees, was $1,500,000. Given that number stays the same, this fiscal year, we will see a 30% increase over that number, which will give us additional $450,000 in potential cost recovery fees. Any questions?
So what, this delineation that you've just presented, that is under the potential additional, is what you said, okay. Then, well, that's potential, but it sounds like, correct me if I'm wrong, that the bulk of this, not discrepancy, but maybe the separation between, let's say 15% revenues in versus 42% of the year, that discrepancy could, a chunk of that could be just that 1/3, 2/3 inversion of self-inspection versus now you have to take your staff and plan out for future on-site inspections. How big of a chunk seems to me like that's at least half of this discrepancy in terms of year-to-date percentages?
Well, it's about $500,000, the difference between the self-inspect versus the manual inspections on the
Okay.
surface.
Okay.
But the total number into the $1 million realm. The thing is, we have experienced setbacks with billing and invoicing and integration technologies. But the work is now ready to be poised to be implemented, and those fees are poised to be recovered over the next fiscal year, into this fiscal year.
Okay, so that section of the work is about $1 million represented in the budget. Is that, I'm
Yeah.
just trying to paraphrase what you said. Is that the case?
Let me refresh my slide here to make sure I'm on the same page with you.
Sure.
The
Maybe I
difference,
should have asked this earlier, Chief, I'm sorry, but yeah, it had to do with a slide a few slides ago. Also, the chart that we have.
the question was based on the self-inspection fee versus the manual inspections, the difference.
What I was trying to do is get a sense, because you've delineated a lot of very important aspects of the cost recovery part of the job. And so in the general overview, we have a bit of a discrepancy between revenue to date this year versus projected in the budget. And that was perhaps about 15% versus 40%, 42.5 or something like that. So what I'm just trying to figure out is of all these items that we're mentioning, exactly where some of these chunks might be made up, some of these revenue streams. And I believe if it is correct, I was just trying to figure out if this switch from 1/3 self-inspection to 2/3 department inspected, district inspected, that is worth about $1 million within our budget revenue side of the chart?
Yeah, the total amount of revenue from the manual inspections is $1.130 million. $1,130,948. That's a portion of the discrepancy. The work has to be completed, and the fees will be collected after that point.
And can I jump in here and maybe I can add some clarification? Because I know the board is pressed with the audits. 2/3 of the people elected to have us do the inspections.
Right.
The engine companies are going to be doing the inspections with iPads, and they haven't hit the street yet. Once they hit the street, which will be in the next week or so,
Yes.
then those inspections will be completed and that money will be collected. And to put it into perspective, those will be the manual inspections that they go out, they spend 15, 20 minutes in the business, and it goes into the cloud and it's billed. If that follows suit, and this is why people are looking at this $4 million number going, what's going on? We've collected 95% of the dollars, rounded off, of the self-inspection fees. So the people that did it themselves, 95% of them have paid. We anticipate it's going to be the same or higher for the inspections that we actually go out and do. So the problem is we're basically pushing, because this is a brand-new program, a bulk of these inspections are going to be done in the last half of this fiscal year, if that makes sense, and billed. And so that's why we're lagging in that area. The other area of revenue that is lagging is the plant inspection fees. To make it clear, we budgeted the same number that we used last year, assuming a bad economy, and we didn't include the 30% increase in fees that we had actually added in, because we've increased fees by 30%.
default.
So that's an uncontrollable number there that we don't have. So to really get to the sense of it, we believe, at least I believe still, we are going to be very, very close to the target. It's just going to come in the bulk of it in the last part of the year. When you look at those large numbers of inspections, remember, we have 42 fire stations. We have X amount of equipment on the street. It averages out to how many inspections per company?
30 to 48.
For the rest of the year. And so they will go out and do that, and that's where you'll start to see that revenue come in. And we were delayed coming out of the chute on this by about a month and a half. So that's really where our discrepancies, if that adds some clarity to it.
No, thank you, Chief Inke. Thank you, Chief Iverson. What I was trying to do was figure out where this bulk of the lagging is coming from. And one we have control over, now that we have the iPads, we have control over it. The other one about plant inspection, well, that's a much larger picture that we cannot truly influence. So thank you both.
And I think the other thing is that those other potential revenues, like weed abatement, those are going to be launched, but we never included those numbers, those dollar figures in the projections. So we've been pretty conservative through this, but it's a new program. It was a heavy lift, and I think we're going to end up narrowing in and approaching where we needed to be at in the end. In other words, there's enough new stuff as well that we didn't calculate in there that should get us to the point for the first year of this program.
I just want to add my comment to Director Jones. I think the reason that we wanted Chief Iverson to come here, this meeting, was the concern that we had over this trend of, at this point, 15% as opposed to the 42% we should be at. And he has done the job we've asked for, which is to explain that there are things in the bill. We don't anticipate this is going to be an adverse condition at the end of the budget year. So that's what we were looking for, and I think he's answered the question. So thank you. Is that not?
I
where we were
concur,
going?
totally concur.
Thanks.
All right, and I added our summary at the top there, kind of sums up what we talked about, that, Community Risk Reduction Division, working with Fire Recovery USA, has experienced setbacks, including but not limited to invoicing and software integration issues. However, we remain confident that we will reach our budget projection by the end of this fiscal year.
I should have waited one more slide, huh, Chief?
No, I think it's good.
No, it's all the discussion, and that's what the meeting's supposed to be about, is discussion.
Chief, are you still getting calls in terms of the self-inspection program? Is that waning because it's pretty much,
I'm proud to say that I haven't had any calls this week or last.
okay.
Oh, wait, let me get my phone now. Take care of that.
Your patience and you're working with the community the way you have, you and your staff.
Well, thank you, and if there's no more questions, I'll turn this podium over to our Chief Financial Officer, Rhonda McFarland.
One more thing for you, Chief. If I could, I didn't get some of the colors on my screen that were in the others. Could I get a printout? Or
Sure.
send me a printout on your presentation? I'd appreciate it.
Definitely.
Thank you.
The light blue doesn't show up, I think. Well, I didn't even-
I got the dark blue, but the other color was,
I could see it perfectly, gentlemen.
You can see it from here.
It's a gender thing, old age.
Or perhaps it's the light reflection.
I'm just going to try to go through the last of my presentation very quickly because we have a guest here tonight from our auditing firm, and she has a lot of information to share with you. So I want to make sure she has enough time to present that. We do have total labor costs of $52.2 million. That's net of $4.3 million in concessions. So we've been talking about that regularly. What a significant contribution our employees have made to our balanced budget. Labor costs through October, we're at 40.3% of the budget. I wrote myself a couple of notes of some things I wanted to share with you. On the right page. Excuse me, we've talked the last couple meetings that we had a lot of deployments. Our deployment number is about 1.6 million in labor costs at this point. And our revenues are coming in about 2 months after we bill. So we've have a lot of it outstanding and presently have collected 275,000. When we deploy people, other people are taking their shifts and we are paying overtime, and that's what we're compensated for. We don't net that revenue into the labor costs, we show them broad. And so if I was to account for what would our labor costs be without the overtime for deployment, it would put us at 39.2% of the budget, which I think is a good place to be because we do anticipate higher expenditures in the last half of the year. We have 1 month, a month and a half of safer firefighters that will be on the general fund. And we also have our single role paramedic program, which is doing their training as we speak and with the implementation March 1st. So I'm feeling comfortable that we did a good job projecting the budget and we're doing a good job controlling the costs. The other thing that I try to look at very closely because it's the hardest part, again, is in the overtime area, looking at the constant staffing. And again, we're in good shape. We're at 39.6% of the budget on constant staffing when we net out our deployment. So in total, we're good, and we're in constant staffing, we're good. Our service and supply costs are at 38.6%, even with some of the things that we pay all up front, like our insurance. So again, overall in service and supplies, we look fine. Okay. So we're going to go on to our capital facilities fund. And to date, we have used 1.3 million of reserves. And this particular fund, we are mandated to use the reserves. These are all restricted monies that have been collected by developers. So it's not like when we use reserves for the general fund. We're not out of kilter. We need to be spending down that money and investing it into the infrastructure. That's what the developers paid for. So year to date, we've collected $495,000 in development fees, and that's 47.5% of the budget. Even though the numbers that Chief Iverson shared with you on plan review, he's lower than he expected. We are right where we need to be. In fact, we're ahead of it as far as what I put in the capital facilities fund for those development fees. I basically budgeted for the exact same amount as what we earned last year. So so far we're fine. You can see when you look at the graph that that kind of money doesn't come in at an even rate. We've got July, I think it's a little over 500,000, and then you've got August, September, October down a little bit, and November. So whereas the prior year, we had that huge amount that we received from the project that SMUD was doing. So that's why that October blue bar is actually off of our chart. So anyway, we're absolutely fine as far as our capital facilities fund goes. In fact, we have at the county for capital facilities, we have $4 million there, and we have $1.6 million in unspent debt proceeds that are restricted to also be used for capital infrastructure. It's being used, the amounts that are left are being used for some of the improvements on the east side of the building at our Armstrong headquarters building. In addition, we have some monies left on the equipping of the apparatus and some of our computer equipment. Okay, going on to grant activity. They have a couple items on the agenda, and I'm not going to steal their thunder. I'm just going to show what we have as of November 30th. And so they've expended $3.2 million and leaving a balance of $8.5 million in awards yet to be spent. We do have a total of $6.1 million that was applied for, the largest being the SAFER grant, followed by the AFG grants. And we just received the $370,000 for in November, we had already received the award for the AFG grant, and the SAFER grant was beyond that point. So I won't give you any more details. You'll be hearing more and more about that from Larry Davis during the regular part of the meeting. Oops. I guess that's my last slide. So I'm going to cue it up for our auditor, Richardson and Company. Ingrid Shipline is here.
Welcome back.
Evening. I have a PowerPoint presentation here. Hopefully you can see the colors okay. Tried to stick with the basic blue and white. I'm here to present the results of the 2012 audit. This is the fourth audit that we performed for the district. We issued 6 reports as a result of our audit. First one being the audited financial statements, which actually this year for the first time was prepared by district staff. We issued an opinion on the financial statements. We also issued a required communication letter that includes various items that we're required to communicate to you. We issued an internal control letter, which contained areas for improvement, and a more detailed letter was also provided to management. This year, at the request of management, we also issued a letter of resolved internal control issue items, and I'll get into that a little bit further, but just to give you an illustration of the items that were removed from the letter, because there was some significant progress made this past year. We also issued compliance reports that relate to the federal grants that you received, and appropriation limit report. I believe all these reports are in your package, but my goal tonight is just to highlight the key points, and if you have specific questions, we can address those as we go along or at the end. I'd like to start by giving you a timeline. I think there's been a lot that's been accomplished by the district as far as audits, bringing audits current over the last 2.5 years, so I thought it would be helpful to provide this timeline. As you can see, the 4 years for the years ended 06 to 09 audits were completed in August of 2010. There was a qualified opinion because the district wasn't tracking its capital assets and inventory. Fiscal year 2010 audit was completed in May of 2011. The opinion was qualified, capital assets were fixed, but inventory was still an issue. Fiscal year 11 audit was completed in January of 2012 with a clean opinion. And then tonight's audit that I'm presenting, 2012 audit, was completed in December of 2012. So you can see from this timeline, there are basically 7 fiscal year audits completed over the course of 2.5 years, which is a major accomplishment by management and staff, and the district has worked hard to get to this point. Some of the audit results and observations. We issued a clean opinion on the financial statements, or unqualified, indicating that the financial statements are fairly presented in accordance with governmental accounting principles. The district established an internal accounting system as of June 30, 2012. You may recall from our presentation of the 2011 audit results that one of the main findings that we had was that the district was dependent upon the county's system and that system was not being maintained on the accrual basis of accounting and didn't provide flexibility to the district as far as being able to make those closing entries in preparation for the audit. For the first time this year, as a result of being able to do or establish the accounting system in-house, the district was able to prepare the closing entries for the first time with the June 30, 2012 audit. So you can see exceptional progress has been made on addressing the findings that we had initially noted in the 04 to 09 audits. The district's been making improvements in internal control processes, but the finance department wasn't fully staffed, so it's really taken until this fiscal year 2012 when the district was fully staffed, as well as the fact that, in the timeline that we looked at, audits were completed. The 2011 audit was completed when you were already most of the way through fiscal year 2012, making it difficult to implement some of those recommendations. So realistically, fiscal year 2012 was the first opportunity that the district had, and with the full complement of staff, we're able to address many of those items that were noted in past audits. Significant adjustments. As I mentioned previously, because the accounting system that was used in the past isn't maintained on the accrual basis of accounting, and because the district didn't have sufficient staff in-house to prepare the closing entries, for the fiscal year 09 through 11 audits, we prepared those closing entries on behalf of the district, and there were about 190 for each fiscal year. For 2012, as a result of being able to hire a controller, particularly, the district was able to complete the closing entries without our assistance prior to the start of the audit, again for the first time. We noted only 6 adjustments as a result of our audit, which is a significant accomplishment considering this is the first time that the district has maintained their own accounting system. So definitely not an issue there, and the district's to be commended for the excellent accounting records that it maintained. I'd like to discuss the highlights of the financial statements themselves, and the numbers I'm going to show up here are on page 16 and 17 of the audited financial statements if you wanted to refer to more detail. And also the numbers that I'm going to be showing up here are the full accrual basis numbers, so those are the numbers in the far right column as opposed to the modified accrual basis numbers. So in other words, this includes all of the non-current assets and liabilities. So looking at total assets, current and other assets of $59 million, that's mostly made up of cash, about $44 million of cash, including restricted cash, and about $11 million is receivables. $72 million is a pension asset, which that's the offset to the pension bonds that were issued and represents the pension cost that hasn't been recognized. That asset gets recognized and recorded as an expense as the service period that the employees' work are incurred. Capital assets are $90 million out of your total assets, and those are basically your infrastructure, land, buildings, equipment, basically non-spendable types of assets. Your liabilities are $191 million. The current liabilities, about $20 million of that is actually the current portion of your long-term liabilities, such as the compensated absences, the post-employment benefits liability, and workers' comp. The long-term liabilities, the $158 million, of that amount, about $92 million of it is for the bonds and the capital leases. About $48 million of that is the liability for the retiree benefits, and about $23 million of that is for workers' comp. And the net assets section of your balance sheet, the net of these assets and liabilities is $30 million. You can see the largest portion of that is your amounts that are invested in capital assets of $69 million. Those are basically amounts that are tied up in your land and building that are not liquid types of resources. The district has $9.5 million of restricted funds. Those are primarily unspent developer and impact fees. Some unspent bond proceeds are in there, as well as the debt service reserves that you're required to maintain. So you can see your unrestricted net assets number is quite a large figure there, and it's a negative. Currently, the district has a deficit of $48 million. as far as its fund balance. And this is just a kind of an indication of the fact that over time, revenues have been decreasing, expenses had been increasing, and it has deteriorated since last year. Last year's deficit was $39 million, so it's gone further negative by $9 million during the year. Looking at the income statement, the revenues consist, you can see, primarily of taxes, $108 million out of the $149 million. Charges for services, which are the medic fees, are $28 million. And then other types of revenues, which are mostly grants and reimbursements from other agencies, are $11.7 million. Expenses, current type expenses, most of that $154 million is salary and benefits. $136 million of that is salaries and benefits, and another $18 million of other operating expenses. Interest on your bonds, $4.5 million, and depreciation on your capital assets are $3.5 million. So the net loss for the year, expenses exceeding revenue, is $13 million. This is actually down from the net loss that was incurred last fiscal year of $21 million, which I think is an indication of some of the cost-cutting measures that the district has instituted this. Am I out? Okay. Okay, am I back on? So you can see there's still a deficit situation as far as expenses exceeding revenues. The internal control letter, there were 7 items, I'm talking about major categories. Within the major categories, there were numerous other subcategories underneath that or recommendations. But 7 items from our prior year report were removed from the internal control letter because they were adequately addressed during fiscal year 12. Those are listed in a separate report, as I'd indicated. 2 of the prior year items are currently in process. One of them has to do with payroll controls and ensuring that there's adequate segregation of duties within the payroll function. And the second comment that's still in progress from past years has to do with the monitoring the ambulance billings. And the district has started procedures whereby those reports are reviewed and has visited the Service Bureau and met with the staff. At this point, it's developing procedures internally for monthly review of reports and reconciling the information to the district's accounting records. There was one new item added to the internal control letter. It had to do with inventory count procedures. I did want to point out there were significant improvements made as far as the inventory taking. As I'd mentioned earlier, our audit opinion in the past had been qualified because of the inventory procedures not being in place. So this really, I think, is just a function of kind of fine tuning. There were some counts that we observed that on the final listing buried. So I think just a review, kind of an internal review process to get from the count sheets to the final listing will resolve this issue. But there has been progress made in that area. Federal grant compliance. Our audit includes verifying that you've complied with all the federal laws and regulations governing the expenditure of federal grant funds. And our audit disclosed no compliance findings related to these federal expenditures. There was one compliance finding noted in the 2011 audit that had to do with tracking of capital assets that has been resolved. New pronouncement. In one of your letters, or actually in the notes to the financial statements, we identify there's a new accounting pronouncement that's coming up. As part of our audit, we try to keep the district informed of any new accounting pronouncements that could have a significant financial impact down the road. And there's one in particular that I wanted to bring up to you, and that has to do with the requirement for recording the liability for unfunded pension benefit obligation. Right now, your balance sheet that we saw earlier doesn't have all of the liabilities on the balance sheet because of the accounting rules don't require the unfunded pension benefit obligation to be recorded. Just to give you an idea of the magnitude, if you look at the June 30, 2011 PERS actuarial report, The unfunded amount, and it's also disclosed in the financial statements as well, the unfunded amount is $173 million. Now, the district's issued $69 million in pension bonds to cover the unfunded obligation, but there's still an unfunded piece of about $104 million that currently is not reflected on the balance sheet. So not only that, that's for the safety plan, but also for the non-safety employees. You're part of a risk pool as far as the non-safety employees, and so this new pronouncement will also require that your share of that risk pool be reflected as a liability. I don't have those figures because PERS doesn't have separate calculations yet for that, but that would also be included as a liability. As far as the implementation date, you'll be required to implement this new pronouncement and reflect these liabilities on your balance sheet as of June 30, 2015. The impact would be we looked at that unrestricted deficit of $48 million. It's going to cause, if you were to put those liabilities on your balance sheet right now, it would cause that number to be more negative than what it currently is by potentially, $100 million. I'd like to thank Rhonda and her staff. I think all of her staff are here, and they all worked very hard in preparing for the audit, getting all the information that we needed timely, and resolving all of the prior year audit findings. So I think they deserve a big thank you for all their hard work that they did.
I'll say thank you to you for working with Rhonda and her staff and getting this done in the short time frame. Like you said, 7 years and 2.5, everybody deserves a lot of credit over there for doing an excellent job getting the material out for us. So thank you.
I just thought I'd make a couple more comments. In the report that Ingrid provided you, where she talked about the deficit, the primary reason there is a deficit, these are full accrual financial statements that she was presenting, and we are required to record the entire arc of our OPEB obligation, our post-retirement medical obligation. And so with us paying out on a pay-go basis, pay-as-you-go basis, about $6 million plus in retiree premiums, the entire arc was in the neighborhood of 16 million. So that put a negative 10 million right into the bottom line. So when you net that, we actually look a little bit better, but it is an obligation we have, and it's something that currently the chief and labor are talking about addressing pre-funding. And we did, as we disclosed in the subsequent event footnote, we did open that trust that the board approved, and in the early summer, we're able to make a deposit into it, and so we're looking at ways to get that number higher. So I just thought that was important, and we also had one new pronouncement that we did implement where we had about $750,000 in expenditures that had to do with debt issuance costs. In the past, we would capitalize those and put them on the balance sheet, and every year over the life of the debt, we would amortize it. When we implemented the new pronouncement, and it was actually an early implementation for us, it was a $750,000 in expenditures that were written off, no longer on the balance sheet, and went to the expenditure side of the statement of revenue and expenses. So I just thought I would mention that. And I do have a lot of my staff here, and I just wanted to thank you all for all your work. And we actually didn't have every seat filled in finance until November of 2012. And our new auditor, Ron Impedrad, that carried a heavy load in this audit, came on board at the middle of May. So, and this was for the year ended June 30th. So we made a lot of progress, and we're continuing to do that. I will also state that it is our intention to keep our books up to date. We right now are not currently up to date with the accrual entries through the current portion of the year, so the first 6 months of the year, because we were busy finishing last year and helping with the audit and getting all the new controls in place. So we'll be working in the next 6 months to get that up to date. Because what you're being presented when you see your monthly financial statements has to do with fund accounting. It's not on a full accrual basis. So we do our budget based on fund accounting because it looks more at, what is coming in this year and going out this year, whereas the full accrual looks at all income that you've earned, all expenditures that you've obligated, and all liabilities that you've incurred. So that's our goal, to start getting you those statements on an accrual basis. We're not quite there yet, so stay tuned. That's the next improvement that you should see as a committee.
Thank you, Rhonda. Just a comment from the chairman's post here. For all the people in finance, thank you for the hard work that you guys have been doing. I particularly, and I'm sure the rest of the board here, appreciates all the details that we're getting in these reports, and especially the colors that show up on them so we can understand them. But we appreciate all the hard work that goes into it. And a lot of times that doesn't get said to each and every one of you. So thank you for coming, and thanks for all your hard work. Okay, next thing on our agenda is the legal bills. Any comments on them? What?
Okay, and I'll second.
Sure you want to pay them?
Move the district.
Okay,
Didn't say, man.
okay.
Director Scheidegger.
Aye.
Jones.
Aye.
Monk.
That was Director Scheidegger. Aye, he'd pay it. Aye, thank you.
Motion passes. Thank you.
Okay, next item is, we have any items for the next meeting, agenda items for the next meeting?
Once we are hopefully reaffirmed in this position on the Finance Committee, then we'll just need to do that, chair rotation that we had discussed last time. But since it hasn't been done, the Executive Committee needs to formalize it. So other than that, I don't have any,
Yeah.
that's sort of more housekeeping, but
Yeah, just for Chief, for your information, all three of the directors on the Finance Committee would like to stay on the committee for the next time, so. And Director Kelly, if you're out there, there you are. All three of the directors wish to stay on the Finance Committee, if the Executive Board so wishes. Okay, next meeting is February 14th, 2013 at 5 PM in this building. And if we have nothing else to come before the Finance Committee, this meeting's adjourned. Thank you for coming, everybody.
thank you, Mr.